Now we're going to look at some examples for Chapter 2 using Excel. So in this very first example, we want to identify the normal balance for each of the following accounts, whether that normal balance is a debit or a credit balance. So remember that within the PowerPoint, there is a very good reference that explains what is a good normal balance for the type of accounts. So example, asset accounts have a normal debit balance. Liability accounts have a normal credit balance. And then the equity accounts, it depends on the account whether it's a normal debit or credit balance. Expenses and dividends have a normal debit balance, while revenues and stocks have a normal credit balance. So here we have fees, revenue earned. Well, we have the word revenue in it, so that tells us it's a revenue account, which means that it has a normal credit balance. Office supplies. Supplies are an asset account, and asset accounts have normal debit balances. Dividends, so we just talked about dividends. Dividends is one of the equity accounts that has a normal debit balance. Wages expense, so remember this is different, so we get confused sometimes between liabilities and expenses. So liabilities mean that we owe people money in the future. We have to pay something in the future. An expense means that we've already paid it. Okay? Expense accounts have a normal debit balance, while liabilities have a normal credit balance. So because this is an expense, we have a normal debit balance. Accounts receivable. So accounts receivable is an asset account. That means people owe us money. Asset accounts have normal debit balances. Prepaid rent. So if you remember from the Chapter 2 videos, all prepaid accounts are asset accounts that have normal debit balances. So this means that we paid money for something that has future benefit. So we paid for an entire year's worth of rent at one time, which means that we get to use this building for 12 months. So prepaid rent is an asset account which has a normal debit balance. So now we have wages payable. So if you remember from wages expense, we talked about the difference between an expense and a liability. If the word is expense, we already paid it, debit balance. If the word is payable, we have to pay it in the future. We have not paid it yet. It is a liability, and liabilities have a normal credit balance. And then our building. Buildings are assets that the company owns, and assets have a normal debit balance. Common stock, we talked about a little bit at the beginning of this video. Common stock is an equity account, and equity accounts have a credit balance. Okay. So now let's go to example 2. The wording on this problem is a little bit different. So this says identify whether a debit or credit, great spelling I see here, identify whether a debit or credit decreases the normal balance of the following accounts. So this gets, if our account has a normal debit balance, then a credit will decrease it. If our account has a normal credit balance, then a debit will decrease it. So this is a little bit different from example 1, so remember to really read the directions carefully here. So we have interest payable. Interest payable is a liability. Liabilities have a normal credit balance. If we have a normal credit balance, then what decreases the account is a debit. So we're going to decrease interest payable with a debit. Service revenue. Revenue is one of the equity accounts. Revenues have a normal credit balance. If we have a normal credit balance, then we decrease with a debit. Salaries expense. So expenses, as we've talked about before, have a normal debit balance. If we have a normal debit balance, then the decrease is with a credit. Accounts receivable. So from example 1, you can remember that accounts receivable is an asset with a normal debit balance. This means that it gets decreased with a credit. Common stock, equity account with a normal credit balance. So we decrease common stock with a debit. Prepaid insurance, asset account, normal debit balance, which means it gets decreased with a credit. Buildings, great, another typo. So the buildings, asset account, normal debit balance, buildings gets decreased with a credit. Interest revenue, so a revenue account. Revenue accounts have a normal credit balance. Accounts with a normal credit balance get decreased with a debit. Dividends. Dividends are a normal debit account. So normal debit accounts get decreased with a credit. Unearned revenue. So this is different. So don't get confused here also with a revenue account. Unearned revenue is a liability. So this means that we've received money for a good or service we have not delivered yet. So unearned revenue is not a normal revenue account. This is a liability account. Liability accounts have credit balances and they get decreased with a debit. Accounts payable. Accounts payable is a liability account. We owe people money, so the payable is the word that says that it's a liability account. Liabilities have normal credit balances, which means it gets decreased with a debit. And land. Land is an asset account. Assets have normal debit balances, which means they get decreased with a credit. Okay. Now let's look at example 3 with net income. So we have different things here. We're trying to determine the net income or net loss for the business during the year for each of the following separate cases. So we have this example here. The owner made no investments in the business and no dividends were paid during the year. So we're trying to determine what the net income is. So one thing that we have to remember is that the net income goes into the equity account. Okay, so if we have at the beginning of the year $60,000 in assets, so first let's look at this. Let's determine what the equity was for each year. So we know that assets equals liabilities plus equity. So if we have just the assets and the liabilities, we're going to find equity by subtracting liabilities from assets. So equity is $40,000 at the beginning of the year. At the end of the year, our equity is $69,000. So we calculate the difference in equity. So our equity increased $29,000. Okay, so in situation A, the owner made no investments in the business and no dividends were paid during the year. This means that the only change in the equity account was from net income. So in that case, the net income under situation 1 is $29,000. Okay, now we have the owner made no investments in the business, but dividends were $1,250 cash per month. So read that, per month. Not that we paid dividends one time for $1,250 cash. It was 12 times. So if we take $1,250 times 12, then we get dividends of $15,000. Okay, we know that dividends are a subtraction from net income before it is added to equity. So that's something we learned in chapter 1. Our change in the retained earnings. So we have beginning retained earnings or beginning equity plus net income minus dividends equals ending retained earnings, or what goes into equity. So that means our net income was $29,000 plus $15,000 because we would have subtracted dividends to add. Okay, so in this case, our net income was $44,000. Okay. So in C, no dividends were paid during the year, but the owner did invest an additional $55,000 in exchange for common stock. So this one's a little bit different because if we invested $55,000, then our difference in equity should be at least $55,000. In this case, we had a net loss. So there's no way that we could have invested in $55,000 and ended up with a difference in equity if we had a positive net income. So since we don't even have a $55,000 change in equity, even though we contributed $55,000 to equity, that means we had a net loss. So we're going to take $55,000 minus $29,000. And this was a net loss, so I'm going to put a negative in front of it. So we had a net loss of $84,000. So here we have dividends were $12,500 cash per month, and the owner invested an additional $35,000 cash in exchange for common stock. Okay, so in this case, we have an additional $35,000 in stock, and we have that $15,000 in dividends. Okay, so in this case, we're going to add the dividends back. So plus the dividends like we did, but then we're going to subtract that $35,000 in common stock. So in this case, our net income was $9,000. Sometimes this can be easier in writing out what those changes were. Okay, so I'm going to continue the last two examples in another video.